Welcome in. Every day on this channel you hear the same numbers. IV rank 77. Percentile pinned at 99. 30-day vol near 70. Beta 1.7. Manage at 21 days. If you've ever nodded along without being completely sure what those numbers actually measure, this video is for you. 10 minutes, and the dashboard stops being noise. Start at the source. Implied volatility. Every option has a price, and buried inside that price is a forecast. The market's collective bet on how much the stock is going to move. Back that forecast out of the option price and you get implied volatility, quoted as an annualized percentage. A stock with a 35 vol is priced for moves consistent with about 35% a year. Want it in monthly terms? Divide by roughly 3.5. So that 35 vol on $100 stock is pricing something like a 10% move over the next month. That's all implied volatility is, the size of the expected move, translated into a number you can compare. It is not a direction. It is not a prediction that will come true. It's the price of movement, and like any price, it can be expensive or cheap. Which brings us to the problem. Expensive compared to what? A 30 vol would be a sleepy day for Tesla and a 5-alarm fire for a utility fund. Raw implied volatility means nothing without context. And that's the job of IV rank. IV rank asks one question. Where does today's implied volatility sit inside this name zone range for the past year? 0 means the cheapest vol of the year. 100 means the most expensive. Rank 50 means dead middle. When the daily brief says Alphabet has an IV rank of 79, it means Alphabet's options are priced closer to their yearly high than at almost any point in the last 12 months. Regardless of what the raw number is, premium sellers care about rank because the edge is selling what's expensive relative to itself. You don't compare Tesla's vol to a utility's volume, you compare Tesla to Tesla, its cousin. IV percentile answers a slightly different question. What fraction of the past year's trading days had lower implied volatility than today? Rank measures where you are in the range. Percentile measures how rare today is. The distinction matters when one big spike stretches the range. One panic day can make every normal day look low by rank, while percentile keeps counting days like a historian. When you see rank and percentile disagree, something interesting is happening, and you've seen a real example on this channel. Silver spent this week with an IV rank around 29. By its own standards, while its raw 30-day implied vol sat near 70. Read that again. 70 vol, rank 29. The rank says silver is cheap relative to its own wild year. The raw number says this thing still swings like few instruments on the board. Both are true. The lesson. Rank tells you what's rich or cheap relative to history, but the raw level tells you how big the moves actually are. A low rank on a high vol instrument is not an invitation to relax. Now the Greeks. 4 dials that tell you what a position actually is, regardless of what you named it. Delta first, because it does double duty. Officially, delta is direction. How much the options price moves when the stock moves $1. A 50 delta call gains about 50 cents on a $1 rally. Owning a 50 delta call is like owning 50 shares, which is why traders use delta to measure exposure. But delta has a famous second job. It's a rough shortcut for probability. A 16 delta put has roughly a 16% chance of expiring in the money, which means roughly an 84% chance it expires worthless. That's the same 84% from our probability video, and it's why sellers speak in deltas. Sell the 16 delta strike and you've chosen your odds before you've chosen your opinion. Theta is the paycheck. It's how much value an option sheds per day, all else equal. If you own options, theta is rent you pay. If you sell them, theta is rent you collect. Every day the market does nothing dramatic. A little more premium melts off and lands on the seller's side of the table. 2 things to know. Theta isn't linear. Decay accelerates as expiration approaches, and theta is the direct compensation for the risks in the other 3 Greeks. Nobody pays you rent for nothing. Vega is the one that blindsides people. Vega measures how much an option's price changes when implied volatility itself moves 1 point. Here's why it matters. You can be right about the stock and still lose because you were wrong about volume. Sell a put. Watch the stock go sideways exactly as you hoped. And if implied volatility jumps 5 points on some macro scare, that put you sold got more expensive anyway. You're down money on a stock that didn't move. Short premium means short Vega. Always. It's the risk that doesn't show up on the payoff diagram. And it's why sellers prefer to enter when vol is already high. Rank. Again. So Vega has less room to hurt them. Gamma is the troublemaker of the family. Gamma measures how fast delta itself changes as the stock moves. Far from expiration. Gamma is small. Deltas drift politely. In the final week or two, gamma explodes. A strike that was comfortably out of the money can become a 50 delta coin flip in an afternoon, and your tidy position starts changing character faster than you can react. That is the entire reason for the 21 days rule you hear in every brief. Closing or rolling around 21 days to expiration isn't superstition. It's stepping off the tracks before the gamma train arrives. You've collected most of the easy theta by then anyway. What's left is the dangerous kind. One more number from the daily brief before we put it all together. Beta. Beta isn't a Greek. It's a stock level number that says how a name tends to move when the market moves. Beta of 1 means it moves with the market. Tesla's beta near 1.7 means that historically, when the index moves 1%, Tesla moves about 1.7, in both directions. Sellers care for one reason above all: portfolio math. 5 positions that each look reasonable can secretly be one giant bet if they're all high beta tech names that crash together. Weighting your exposure by beta is how you find out whether you own 5 trades or 1 trade wearing 5 costumes. When the brief says Tesla is doing what high beta names do, that's the shorthand. It amplifies whatever the market is already doing. Now let's put it together and read an options chain, because every number we've covered lives there. Open any chain and you'll see calls on one side, puts on the other, strikes down the middle, 1 row per strike, 1 tab per expiration. 3 things to check before anything else. First, the bid-ask spread, the gap between what buyers pay and sellers receive. That spread is your real cost of doing business. You cross part of it getting in and again getting out. A penny-wide spread on the S&P fund is a toll booth. The 20-point wide market we flagged on the Euro fund this week is a locked gate pretending to be a quote. If the spread is wide, the posted price is fiction. Trade something else. Second, open interest and volume. How many contracts exist and how many traded today? Liquidity is what lets you leave a trade when you need to, and you find out how much it matters at the worst possible time. Third, days to expiration. Because as we just covered, the same strike is a completely different animal at 45 days than at 7. So here's the full decode. Using a real line from this week's brief. The Nasdaq fund at an IV rank of 82 with its percentile at 99.9. Translation. Index options were priced richer, relative to their own year, than on 99% of days. The market was paying up for protection. A seller hears, premium is on sale in reverse. I'm being offered top dollar. The 45-day, 16 delta strikes define the trade with roughly 5 to 1 odds of expiring worthless. Theta collects the rent. Vega is the risk if fear keeps rising. And 21 days marks the exit before gamma takes over. 1 sentence of jargon, and now it's a complete business plan. That's the dashboard. Implied volatility is the price of movement. Rank and percentile tell you if that price is high or low for the name. Delta sets your odds. Theta pays you. Vega and gamma are what you're being paid for. And the chain is where you check that the market will actually let you in and out at a fair price. Nothing on this channel is more complicated than that. This video is for information and entertainment only. Nothing here is financial advice or a recommendation to buy or sell any security. Options involve substantial risk and are not suitable for everyone. Do your own research and size your own risk.